I'd like to bring in Charu Chanana now, market strategist at Saxo Markets. She's here with us in our studio to talk about those latest measures, of course, by China to address, overseas funds fleeing China markets. Let's talk about the appeal of Chinese equities now. And do you think the measures will be able to catch up with the rate at which these funds are flowing out of the mainland?
Yeah, the sentiment has turned down pretty steeply. And if you look at what's happening in the domestic market specifically, is that the Chinese households as well as the corporates, they're really on a deleveraging mode, right? So any of these measures that the Chinese authorities have been taking so far to kind of, support the economy in the form of rate cuts or some of the other measures as well have not been able to bring the kind of impact that would have been expected, because when somebody's in a deleveraging mode, you can't expect them to take on more loans or more debt, right? So certainly, and then it has also been a negative for banks who've lost additional capital, to be able to pass on those rate cuts. So they have to come up with more and more measures specifically to support the banking sector, to support their capital adequacy, to address some of the solvency issues as well, so that the stimulus measures that they announce are actually passed through to the economy.
Charu, we're also keeping a close watch on Japan's inflation figures. CPI figures show that it has eased slightly. Are we expecting that to sustain, and what does this bode for the yen?
So we've certainly seen some amount of easing in the headline measure, but if you look at the core measure, which actually excludes food and energy prices, they've still been quite firm. We've seen them this morning for the Tokyo region come out at 4% again, which means that the assumption that the Japanese authorities have been working on, that all of these inflation pressures have been driven by external factors, or they've been driven by the supply chain issues, may not hold true, because we are seeing the measures have an impact across the economy in the services side as well. And if that does translate into wage growth eventually, which is what the Bank of Japan is waiting for as well, I think we could see some measures coming through from the Bank of Japan as a result of that as well.
Well, Charu, we're also paying attention to the Fed's Jackson Hole meeting. We're expecting them to give more clarity on the policy path. At this point, we've heard some rumblings that, the Fed may be close to the end of its tightening cycle. Given that we also saw earlier in the week a PMI, U.S. flash PMI falling to 50.4 in August, what is the likely path that the Fed would take? What we expect from Jay Powell's speech?
I think it will be hard for him to really give any signals for the September meeting, potentially because we still have a lot of data due ahead of that meeting. We get the PCE, we get the NFP next week, and then we also get another CPI print just ahead of the September meeting. So likely, I think it will be the safest for him to kind of maintain a data-dependent approach for now. But when it comes to Jackson Hole, the focus is less so on what happens the next month or two, but more so on the structural part of the policy, and that is where the real conversation needs to happen, because there's been growing murmur about the fact that U.S. economy potentially needs a higher long run neutral rate, because so far we are at 5.25–5.5% or so, but it does not seem to be restrictive enough. The economy has not been slowing down because of that. So if there is a conversation around a higher neutral rate in the long run, that could still be seen as a hawkish message. But I would really think that he would stay away from commenting on the near-term path.
And a very quick one before we have to go, but we see markets already sort of reacting to this quite hawkish stance. They failed to sustain that rally overnight that was helped by Nvidia's results. So is this something that the Fed should be considering as well?
Certainly, and I think the market direction is coming through as a bit of a caution ahead of that, comments that were supposed to come out of Jackson Hole. But certainly, in the near run, there is going to be some impact from the high interest rates that we've seen for some time now in the U.S. economy. There are concerns setting in about, like you said, the PMIs, whereas, so far we've seen contraction in manufacturing, but that's now spilling over to the services side as well. There are concerns about a huge wall of corporate debt that is getting matured in the next year or two, and how that will have to be refinanced at higher rates. We've seen a lot of concerns about the banking sector as well, right? And we've seen some downgrades there as well. So I think the regional banking sector is still of concern as well. And these are some of the factors that will continue to define what kind of a direction the markets will take from here.
Charu, appreciate your insights and for coming in this morning to our show. Charu Chanana there, a market strategist at Saxo Markets.